Welcome, tackle traders. Another edition of the Rookie Blog here. This is our next live trade that we're looking at. We've been through the stock. We know how to set up stock trades. We've put on our first live trade. We know how to manage that one as well. We know where to put our stop losses, where to put our targets. And this week we're talking about doing a long call. We're talking about churching it up here. Start throwing some option plays in here, and what we need to find to do those kind of trades. Now, last week we talked about time and volatility. This week we're going to go a little bit deeper. We're going to talk a little bit more about that volatility and how we use it. And we're also going to talk about the length of time that we need to be in a trade to make it successful. So went through about 5 different points there in the write-up. This is just a video to go along with it. We're actually going to look through a trade here and see how to set one up and kind of go from there. So the first thing we need if we're doing a long call is we need a bias. Okay, so the reality is we need a bullish stock. It's a bullish type trade. We need a bullish stock, but it not only has to just be bullish, it has to be aggressively bullish. Now, what do I mean by aggressively bullish? Well, when I start looking at the longer time frames, so we'll pop this out to a 1 year here. You can see here that this thing has a tendency to move, and it's been moving very good, from left to right. It's been moving upwards for a very long time now. This is a year chart. If we go look at the 3-year weekly and go back even further, you can see here that for 3 years this thing's just been moving up. Okay, so right off the bat, my bias is jumping to bullish there. Now the question is how bullish am I? Well, the reality is we're looking for patterns here. This is what we do as traders. We're looking for patterns that we can exploit. So the 2 main patterns that we focus on for bullish trades are the bullish breakout and a bullish retracement. Well, you can see here that this stock here popped up real nicely on earnings and then had the perfect 3-day pullback with some slowing momentum, and then showing us a green candle here. Okay. So in this particular case, I would be pretty aggressively bullish on this thing just because it's above all the moving averages. It's past earnings. It had a real big pop. It's coming back. It's showing that it's taking a little breather here, and it could be ready for the next leg up. Okay, so I would definitely say that this is more a +2 to +3 bullish bias here. I think you guys can see that, and I think that makes sense. Okay. So the other thing, like I said, the second thing we're looking for is a pattern. Well, we're looking for a bullish retracement or a bullish breakout. Well, you can see here we've got a classic 3-day bullish retracement, and we got this green reversal candle here. Okay, so now what we're looking for is a pop up above here for an entry. All right. Now, the third thing we talked about is implied volatility. I talked about volatility last week. Now, one of the ways we use implied volatility, and it's just one of the ways, there's so many different things about volatility that we'll eventually get to all of them. But for this one here, I just want to talk about implied volatility. It's the expected move for an equity, on a somewhat regular basis. Okay, so it's where we think it can get to. There's a lot of calculation that goes into implied volatility, but for us to kind of bring it down to a basic level, what we're looking at here as we're looking at this blue line here. This blue line is the implied volatility. The purple line is the historical volatility, and this is the ATR. Okay, so what we're looking for when we do these trades is we know that implied volatility, a rise in implied volatility will help us overall, because what it will do is it will expand the credit in the options. So right now we're looking at this, and we got a lower implied volatility, and historically the volatility of this equity is higher. So this tells us that we've got some room to move in volatility here, which if it does move, then it's going to increase our option premium, which is at the end of the day what we want to do. This type of trade, the long call trade, it requires that we have expanding volatility, or at least that helps our trade. So now we're putting ourselves in a position that can come to fruition. Okay, so now we talked about time last week. The thing about options versus stock is they have an expiration date. Like they're basically a carton of milk. It's going to be good for a little while and then not so good later on. So we need to make sure that we're aware of that, and we need to put ourselves in a position to take advantage of that. So we'll talk about that more in a minute when we actually put the trade on. So we've got our bullish bias, we've got our pattern, we've dealt with our implied volatility. It's all running good here. We can deal with our time with our other rules. Now we need an exit plan. Okay. So the exit plan typically comes down to we need a stop loss in case we're wrong, and we need a target in case we're right. okay? And we want to set those things up. So before we do that, let's get right into to making a trade here. So the reality is with this trade here, we want to enter this just like we would a stock. We want to go above the current price now, above the high price of this right now, because we want to get in as it's moving up and not as it's moving down. So in this particular case, if we went 10% of an ATR, above the high of the day, we'd be looking at 126.64. The high of the day, the ATR is 55.56, so we'd be about 55 cents above that. So in this neighborhood, we'd be about 127.10, right around there, that we would enter this trade. Okay. So if we enter this at 127.10, now we gotta follow our rules. Okay. So the way we're gonna do this is we're gonna go in and we have rules for the calls that we're gonna make. Okay. So let's deal with time first. The reality is we got to give ourselves more time to be right and not less time. When we're selling options, we use less time. In this case, I want to go at least 3 to 4 months out. And really, this September option is really tight, but the December is quite a ways out. But I think I want to err on the side of caution here. So I'm going to click on the December, which is 142 days out. Okay, so now we want to look at the 60 delta. That's our rule, the closest to 60 delta for our option play. So in this particular case, we've got a 62 delta option here. So this is the one we're going to buy. Okay, so we're going out to 3 to 4 months where we've got our 60 delta, and now we got to look at this and we got to say, okay, we only want to get into this if it does what we want it to do. Okay, so that's where we go into here. And we want to put some things in here. First of all, we don't want anything to do with this trade unless it does what we want. So we want to go greater than or equal to 127.10 is what we came up with. Okay, and now we want to link this up. We're going to leave it as a limit. We're going to go to the mark price, and we're going to add a little bit, because we want it to be in the middle of the bid and the ask. So we'll add a bid here. This is a high dollar stock. I'm going to add 50 cents. Now that could be a little bit much for the stock, but we know that it's got a $5 ATR. So at the end of the day, I feel confident this is a good setup. So we'll just save that. Okay. So now this is going to get in, and it's going to go to the mark price of whatever this is worth once it hits 127.10. If it doesn't hit that, it's not going to do anything. Okay. So this is the first setup. Now we need to make sure that we have contingencies in place just in case something goes wrong. So what we can do is we can go first triggers OCO. So what we want to do is we want to make some opposite orders here. We want to have an opposite order to get us out should something go wrong, and we want to have an opposite order to get us out if we make some money. So we got to do a couple things here. We're going to do a stop loss. Okay. So the stop loss we're going to do on this one, because it's an option, what I want to do is I want to get out at a percentage of the overall cost of the call. Okay, so let's assume the cost of the call is going to cost us $16.50. I like to use the metric of 30%. Some folks go a little bit wider than that, but I think 30% is just fine. So if we take 30% of $16.50, that's 0.3, so that's about $5. So $4.95. So we take $5 away. Basically, I want to get out of this thing at 11 bucks, right? 11.50. Okay, so that's $5 away from what we're there. If it drops that $5, that tells me that either volatility bled out or it's going the wrong way, and that's going to protect me. Okay, so that's our first order there. Okay, we're going to make that good till cancel, and we're going to go with this next one. This is our limit. Okay, time and force. So it says they have to have the same force. Okay, so we'll make this good till cancel as well. And now this one here, what we want to do. Actually, sorry, that we can leave that day. We want to make this one good till cancel, and then it'll get rid of that little thing on us. So now we want to make our limit. Now this is where we want to target. So now we're looking at this, and I say, you know what? I think this thing could easily get back up to, I would at least say the 140 before it ran into some problems. Might get a little bit of a hiccup right here at the top of this candle, 136, but I think if it gets to that, it can get to the 140. So we'll use 140 as our target, and I think that's reasonably conservative. Okay, so now we want to put this in, and we want to put a limit order in, and we want to go with a price here. So we don't want to do that. We want to make sure that this thing, as Grubs gets up to greater than or equal to, we'll go 139.90. Okay, so we're just below our 140 target here, and then we'll give it a little bit of space here. Let's just go back in here. Look at this mark. We'll give it a limit offset of less than $1. I'd rather just go with the market on this one. Okay, so this thing, once it gets up to, actually we can just go with the actual straight up limit there. We'll go with the manual. Okay, so we're gonna just go with the manual limit here. We're gonna get rid of this. There's a few different ways you can do this. We'll just use this one for now. We'll save that, and we're gonna go. And so this one, we'd have to sit there and figure out what the expected price is here and what our option price. So the way we do that is we just click this up till we hit 139 or 140. So we'll just go through this. You can see down at the bottom there, we're getting up rapidly, getting close. So somewhere in this neighborhood here, and we'll be conservative, we won't shoot for the moon. We'll go 139.59, you can see down here. So we've been looking at getting out of this thing at 25 bucks. Okay. So now we have our buy stop limit getting in, we have our stop getting out, and we have our limit, our target as well. So this way we've set up we've set up our exit plans, we've set up our targets, and we've used good exit plans to get out. We're going to get out if we lose 30% of the option value. There's lots of other ways to do this, but this is one of the easier ways to do this. So click confirm and send, and this order will go in.